Yeah.
Okay. Can you all see my slides on your screen?
Yes.
Okay. There's about 20, 1, 2, 3, 4, 5, 6, 7. Okay, about 30 of you. So I'll just start. The topic today actually is on partnership, which is quite a short topic, but when we go through the examples, hopefully you'll have the textbook in front of you. Yeah. But what I want to do today is also to recap on the last 2 lectures. Just one slide on each of the 2 topics that I've already lectured the last 2 weeks, which is computing trading income and capital allowances. Yeah. So when you look at the chapter on computing trading income, just remember this chapter is also similar when I cover corporation tax, so taxation for companies. Yeah, it follows the same principle as personal income tax. So with computing trading income, I think the important thing to remember is that the net profit in the statement of profit and loss must be adjusted to find the trading profit. Okay, so in the financial statements, yes, you have your net profit before tax, but then you need to add back items that are disallowable in terms of the expenses incurred, and also you reduce the taxable profit by, for example, capital allowances, allowances that are allowable. But the most important thing, obviously, in terms of personal income tax, is the fundamental concept is that the profits of the business must be calculated in accordance with the general accepted accounting principles. And what is that? For both personal and for companies, it is the accruals basis. Yeah. So if you do, or if you're in a situation where you have to review financial statements in terms of expenses, then the important thing is you need to ascertain what expenses are allowable and what are disallowable. Okay. So if my PowerPoint does give details, and the chapter does give details what expenses are allowable and disallowable. Yeah. So the effect of disallowable expenses, they will be added back to the profit, and the impact is it will increase the taxable income. So, like any tax authorities in the world, they're always concerned about what expenses have actually been charged to the profit and loss account. Yeah. So the important thing is to analyze each of the expenses and to ask yourself whether the expense has been incurred wholly and exclusively for the purpose of the business or not. In the UK, we call it wholly exclusively incurred for trade purposes, but in Brunei, we use the word wholly and exclusively incurred for the purpose of generation of income. Yeah, which is the same thing, but we just changed the word a little bit. Okay, so when you have revenue in your profit and loss account, the tax authorities are concerned that the expense that have been incurred are related to the generation of the revenue, or in terms of the trading income of the company. Now, certain other items such as depreciation are specifically disallowable. Yeah, so if you remember when you look at the computation of taxable trading income, you start with your net profit, you add back certain items, depreciation, capital item, if you have incurred legal expenses. Oops. What happened to my, oh, okay, right, it's back in. So, okay, so we need to see, okay, legal expenses that's related to capital item, for example, if it's for drafting of tenancy agreement, if it's for relating to the purchase of capital item, then it's not an allowable item. But if relating to the recovery of a debt, then, and it is a trading debt, then yes, it is an allowable expense. Okay. And then last week I covered capital allowances. Now, as depreciation is not allowable, the Brunei authority and the UK authorities do provide capital allowances. Yeah, so capital allowances are available to give tax relief to certain capital expenditure. Now, in doing the computations, if you remember the pro forma last week, yeah, the most important thing, I mean, you had an exam, is to know what the format looks like. Main pool, what are the annual investment allowances, how the columns are set up. And once you are given the information in the figure, you just slot in the figures under the relevant heading columns. Yeah. So the main pool comprises of mainly expenditure on plant and machinery and low emission cars or motor vehicles. Now, remember that companies are entitled to an annual investment allowance of £200,000 for a 12-month period. Yeah, so the most important thing to remember is for a 12-month period. And companies are also entitled to a first-year allowance at a rate of 100%, yeah, for low-emission cars. The first-year allowance is not prorated, whether it's a short or long period of accounts. Now, for any also expenditure on plant and machinery in the main pool that is in excess of the annual investment allowance qualifies for a written down allowance of 18% every 12 months. Okay, so you get annual investment allowance, 200,000, and a written down allowance of 18% every 12 months. Okay, so the most important to remember that for short or long accounting periods, for both the annual investment allowance and written down allowance, this must be adjusted accordingly. So if it's only a 9-month period, then you reduce the amount by 9/12. If it's an 18-month accounting period, then you increase the figure by 18 divided by 12. Okay. Now, for first year allowance, there's no adjustment required because you get 100% allowance irrespective as to whether it's a short or long accounting period. Okay, so if it's a 9-month accounting period, you don't do 9/12. For first year allowance, it is given as 100% allowance. So as I mentioned last week, so sometimes the government uses the capital allowances for government policies in terms of encouraging investment. So in Brunei, for example, you want to encourage investment for companies to buy plant and machinery, build a factory, expand the business. What they could do instead of giving an initial or first year allowance of only 20% is to increase it to 50 to 100%. Yeah, but the best way to encourage companies to invest is to give them more incentive. Yeah, but remember that when you give incentive upfront, you're only deferring the tax liability to a future period. Yeah, if you remember, I mentioned what deferred tax is, or someone asked what deferred tax is. Deferred tax, as the name suggests, is a deferral of taxation. So if you get 100% allowance this year, you'll get 0% for the next, for the following period, and over those useful economic life of that asset. But depreciation is over 5 years, so it's 20,000 every year. The subsequent years, because depreciation is a disallowable expense, you add back 20,000, for example, 20% depreciation, but you do not have any allowances. Yeah. So this year you have 20% depreciation, but you have 100% allowance. So a net effect of 80% benefit. But in the following 4 years, you have a 20% liability. Okay. So there's a deferment of tax from this year to the following year. But if a company keeps investing every year, then the deferred tax liability can be reduced by the amount of new investment that has been made. This is quite common in the UK because a lot of companies do spend and invest a lot of money in investment, in expansion, in innovation, in development of the business, enhancing the business, making the business efficient, more productive. So that's what the government is trying to do, yeah, to promote entrepreneurship, technological enhancement, and everything around the expansion of the business and the promotion of of entrepreneurship. I don't have many slides for this presentation, but later on what we do is we'll just go through quickly, yes, some of the examples. So when you go back to your business law or company law, what's a partnership? And in Brunei is also stipulated, yeah? A partnership comprises of between 2 to 20 partners. And usually a partnership is a group of individuals who are trading together. Yeah, so if 10 of you decide to go into business together, then you would set up a partnership in Brunei to do that work. Yeah. Usually, as partners, you should agree among yourselves how the business should be run and how the profit and loss should be shared. I'll cover that in more detail. Yeah. A partnership is simply treated as a source of profit and loss for trades being carried out by individual parties. So the 10 of you are in business together as a partner. What you do is you calculate individually what your income, your profit is for each of the partners. And then from there, you're each taxed individually as partners, yeah, under personal income tax. So then it goes to chapter 1 where you have savings income, non-savings income, and dividends. Okay, so partnerships, all of you coming together, but you're each assessed individually as individuals in the partnership. Yeah, so what are the terms of partnership that are available? The most common is, of course, business partners, like 2 to 20 of you coming together and decide to do a business, whatever business that you think is suitable. But on the other hand, is, for example, like me, when I was a partner of KPMG, we are partners of a professional firm. So professional firms could be accountants, lawyers, architects, surveyors. Yeah. But as partners of a professional firm, you need to meet certain criteria before you can be admitted a partner. So if I decide to go into, like a normal business with any of you, we just set up a partnership, we decide to do business. But when you're in the professional field, you do not become partners automatically. So for example, like myself or with any accounting firm, for example, you need to meet certain criteria. You need to be able to add value to the partnership. You need to be able to have brought or be able to bring in business to the partnership. Yeah. So we assess on a number of things. One is our technical ability, our human resource capability, and our PR and marketing skills. So if we have these qualities, then the partners will consider admitting you as a partner. Okay, so partners of a professional firm, you need to be professionally qualified and have the qualification that is relevant to that industry. So if you want to be a partner in an accounting firm, you need to have a professional qualification. Any one of the recognized qualification, the Chartered Accountant of England and Wales, Scotland, Ireland, ACCA, CPF Australia, and so on. Yeah. If you want to be a partner of an architectural firm, engineering firm, you have to be a member of Puja in Brunei. Puja is a Persatuan for untuk Jurutera and Architect, which is monitored under the Ministry of Development. So when you see someone said, "Oh, I'm a partner of this firm and that firm," and if it's a professional firm, then they have that professional qualification. Now, in a partnership, there are different levels of partnership. For big accounting firms, what would happen is sometimes you are admitted as a partner, but you only receive a salary. Yeah, so you're a salary partner. That means you get no profit share. They just give you a certain amount, 5,000, 10,000. It can be for up to 3 years, 5 years. Yeah, so basically you come in as a junior partner, you get a fixed salary, and then it's up to you to prove yourself. If you can generate more business for the partnership, you can increase the number of clienteles, then it's a possibility that instead of being a salary partner for 3 to 5 years, they might make you only a salary partner for 2 years, and after that become profit share. So it's important that once you come in, you are able to add value to the partnership and also increase the value of the partnership. And you have limited liability partner. What is a limited liability partner? So you become a partner. So for example, with KPMG, I was a limited liability partner when I started, and I became a partner more than 30 years ago, because the firm was owned and controlled from Singapore. The audit license was held by a partner in Singapore, and I didn't have an audit license. So although I was a partner, I functioned as a partner, but in order to cover myself, I ensured that I have a limited liability. So if anything goes wrong in Brunei, which is not my fault, then Singapore will cover me and indemnify me. Yeah. So as you know, with partnership, you have unlimited liability, compared to a Sdn Bhd. So with a partnership, it was important for me, because if I do not have control and someone else has controlled the partnership, that I have limited liability. So I kept my liability to a certain amount. And the next one is profit sharing partner. So profit sharing partner, now accounting firms have a retirement age. So in my case, it was 58. Yeah, 58 was the retirement age. Now they've moved to 60, some countries 63. But why are they quite strict with enforcing the retirement age? When you have a big organization of more than 100 partners, like we have overseas, then it's important that people do not stay in their position forever. Yeah. So the important thing is to make sure that people retire at the right age, so that there's no bottleneck at the bottom. So the junior partners, the salaried partners, limited liability partners can slowly move up the chain and become a profit sharing partner. Then the longer you are in the firm, the higher your profit share. When people retire at the retirement age, then you slowly move up the hierarchy of the partnership. So the partnerships, have different types. Business partners, or your partner in a professional firm, salary partner, limited liability partner, profit sharing partner. There are situations where you are both salaried and profit sharing partners, as you will see in the examples that we will go through. Now, like any partnership, there will be changes of partnership during the year. Yeah. And there are reasons for changes in the composition of the partners. And this is very important in terms of the dates of these changes, because when you do the tax computation, you need to make adjustments to the partnership's share of profit, salaries, wages, and so on, interest on capital, when there are changes within the partnership. So the most common partnership changes would be, the first one is retirement. Yeah. So retirement is, in the partnership agreement, you have stated that, okay, when you reach 55, 60, 63, whatever it is, you will automatically retire from the partnership. Okay. A lot of people don't understand how come, although I have an equity share in KPMG, I had to retire, but that is a mandatory requirement for all partners globally. Yeah. Whether you're equity partner or salaried partner, when you reach retirement age, you have to retire. So then that's a retirement. The way that KPMG used to work, which is a bit easier, is our financial year end is end of September. So when you retire from the partnership, when you reach the age of your retirement age, you serve until the financial year end, which is end of September. So then any changes to the partnership only happens at the start of the year, not in the middle of the year. Okay? It's the same thing like admission. When we decide to admit someone as a partner, they'll be admitted on 1st October. So at the start of our financial year. So in a perfect world, the retirement and admission of partners is always done for KPMG on 1st October. I think Deloitte is 1st July. Ernst & Young, Pricewaterhouse, the other accounting firm, it's probably 1st January. Yeah, so we follow our financial year end. The next one is removal. Okay, removal is not very good. That means you've done something wrong. Yeah, it's a polite word for saying that you have been sacked from the partnership. So removal occurs when the partners of the firm decide that you are no longer an asset to the partnership, or you have done something wrong, or you've been negligent in terms of your work, or you've been suspended by the Accounting Association or the central bank or the regulatory authorities from acting as a partner because you did not do your audit work professionally and in accordance with professional ethics, you will be removed from the partnership. So a removal does not start at the financial year, and it can be any time. Yeah, so a person can be removed anytime during the year. And then death. When someone dies, they are no longer a partner of the firm. Yeah, an estate cannot be. So if you have a beneficiary, you have an estate, they cannot be partners of the firm. So upon death, what will happen is the partnership will make a valuation at the date of death, and whatever is due to the person that died, that money will be given to the estate, and it's up to the estate to decide how they want to distribute the money that they receive. Obviously, if it's under Sharia, then it'll be under Faraid. But if it's other, if someone has done a will, then you do it through a will or whatever the law is in that country. Yeah, okay. So when you're a partner of a firm, we need to look at two types of arrangement. Actually, there's three, yeah, one more. One is salaries. What salaries are you going to pay each other? Because once you set up a partnership, you're not going to, some of you may not want high profit share, some of you may only want salaries, because you need to have a stable income every month. Yeah, because you know, say if your cost of living is 2,000 or 3,000, then the important thing is to make sure that the partnership can generate sufficient income to pay a salary of 3,000. Some partners may be a bit more stable, or they've put more capital in, yeah? Then they have profit shares based on the amount of capital that you put in. Now, some partnerships, when you put capital in, you're entitled to what's known as interest on capital, 5%, 8%, depends what the law of the country is, yeah? So when you put in capital and you're entitled to interest on capital, then that obviously will reduce the amount of profit that will be distributed to the other partners. Yeah? Because when you make a distribution, you have your profit, then you have to reduce it by the amount of interest that you can get, and then the balance is distributed depending on the profit sharing ratio. Okay. I think 2 more slides, then we will go through examples. Actually, after this, we'll go through examples. So allocating partnership profits between partners, how do you allocate it? The profit sharing ratio, obviously, for partners will be predetermined. Yeah, if there's 2 of you and you both put in 10,000 into the business, then you share 50-50 each. Yeah, I mean, it's straightforward. If there's 3 of you, one of you put 50%, another put 30%, the other put 20%, then your profit sharing will be 50, 30, 20. Now, in some cases, partners may prefer a higher salary, but a lower profit share, because they do not want to take too much risk and say, oh, I prefer to be paid higher. And I mean, you can take some of the share of my profit. So they want to get a guaranteed salary every month. Yeah. So it depends on how your arrangement is between you and your fellow partners. Some of the biggest downfall or collapse of partnership is someone decides to take a salary and lower profit, and suddenly the company starts doing well because you bring in the business. Yeah. Suddenly you're bringing in business, you're generating more income to the business, but you get a lower share because you've agreed a higher salary rather than profit share, then you try to change the terms and conditions of the partnership. This is where it can get a bit tricky. Yeah. So in computing the partner's profit or loss, this would have to be divided according to the profit sharing arrangement in the period of account. And for partnership, your accounts are for a 12-month period. Not if it's more than 12 months, then you have to split into 2 accounting years. Yeah. Now, if partners are entitled to a salary or interest on capital, this will have to be apportioned first, and then this will then be prorated in periods of less than 12 months. We will go through, I think, 4 examples, yeah, very quickly. Then you can see how it works. Now, once the partnership profit for a period of account has been computed, they are shared between the partners according to their profit sharing ratio. So what we'll do now next is just go through a few examples. Yeah, then it gives you an idea as to how a partnership's profit is computed. So let's go through. If you have your textbook, turn to page 173 and just look at the first example, yeah, on Steve and Tanya. Now, the one thing that you will notice about partnership pro forma is, if you remember, for example, like personal income tax, you have non-savings, savings, dividends, you have total. And then for capital allowances, you have your different pools, first year allowance and so on, you have total. For partnership, total is first column. Yeah, the uniqueness with partnership accounts, total is the first column, and then the headings will be the names of the partners. Yeah. So if you look at this example here, Steve and Tanya has been in partnership for many years, preparing accounts to 31st October. For the year ended 31st October, taxable profits were 70,000. Steve is allocated an annual salary of 12,000, and Tanya a salary of 28,000. The profit share is 2-1. Yeah. Show the trade profit allocated to each partner for the period of account ended 31st October. Now, when you look at the answers, the total profit is 70,000, yeah? So that's the first line. Now, what you need to do is, we know salaries of, in total of 40,000 has been paid. So when you have profit of 70,000, salaries of 40,000 is paid, the balance will be 30,000. Yeah, so if you look on the left side, you'll see salaries, balance, trade profits allocated to partners. That balance will be allocated to each partner based on their profit sharing ratio. Yeah, so in this case, 30,000 divided by 3 times 2 is 20,000 times 1 is 10,000. So Steve has a trade profit of 32,000 and Tanya 38,000. You can see from this example, if profit increases, Steve shares will slowly be more than Tanya. Yeah, you can work it out now. Once let's say if it's 100,000, let's say 100,000 profit, 60, 40, 20, 40, 20, 48, 30, 52. Yeah, okay. So if profit was 100,000, Steve will be earning more than Tanya. Okay. So when you look at a partnership arrangement, in this case, as you can see, Tanya has taken a higher salary, but a lower profit share. The risk for Steve obviously is if profit is low, he will earn less than Tanya. But of course, the benefit from him is as the company grows, as the profit increases, he will reach a point where he'll be earning more than Tanya. So he doesn't take a high salary, just whatever he thinks is reasonable, but he takes a higher profit share. Okay, any questions on this example? No, sir. Okay, so So the next one is taxing the tax position of individual partners. I think this one you can go through. I mean, I will go through now, but if you don't understand, just go through it yourself, because I think it's important that you understand this. As I said, although it's not relevant for your exam, but if you do decide to do taxation at a professional level, it's important that you understand the tax computations, the format that I have presented to you, or that's what's in the textbook. Otherwise, you'll be totally lost when you start doing the advanced level for taxation. So for this example, is Acela and Victor has been in partnership for many years, preparing accounts to April. There's trading profit of 45,000. Victor has allocated an annual salary of 5,000, and the remaining profits are then shared between Acela and Victor in a ratio of 3:1. They have no other source of income. So compute the taxable income for Acela and Victor. This one you have to go back to chapter 1, but this is just only non-savings income. Yeah? So there's only one income that they receive. So first we allocate the profit, just like the previous example. Total profit is 45. Victor has a salary of 5,000. So the balance is 40,000. And that balance is split between Acela and Victor based on the agreed profit sharing ratio. So then you have Acela 30,000 and Victor 15,000. Okay, so when we do the taxable income for personal income tax, we know that Acela and Victor has got an income of 30,000 and 15,000, but as individuals, they're also entitled to personal allowance. For this particular year, it's 11,850. That's it given in the tax table. Okay, so the taxable income then is 18,150 and 3,150. Then you will look at the tax table and see what the relevant tax rate is. For in this case, I think it's only 20%. Yeah? But it's only asks you to calculate taxable income. Yeah, so that's just a straightforward example on how to calculate taxable income for individuals after taking into account personal allowances. Okay, the next example relates to change in profit sharing arrangement. So sometimes partners may decide that, midway through the year or sometime during the accounting period, they want to change the profit sharing ratio. They want to change the level of salaries that they pay each other. So, as long as you're in partnership and all partners agree to the change in profit sharing ratio and they agree to the change in the salary, there is no issue, no problem, yeah? Because that's what a partnership is. A partnership is where individuals come together and agree on things jointly when they do decide to change things. Now, in exam questions, it is very common to have changes in either partnership, changes in the composition of the partners, changes in the salary and profit sharing ratio during the year, not at the end or at the start of the year. Then you need to split the calculation of the profits depending on when certain activities have taken place. And so in exams, you wouldn't get simple questions like the last two examples. Yeah, it'll be a bit more technical, a bit more complicated in the sense that you need to be very methodical in terms of when you do the split of profit if changes happen during the financial year. So let's look at this next example on page 175, yeah? Changes in profit sharing arrangement. So Sue and Tim has been in partnership for many years, preparing accounts to 31st December. For the year ended 31st December, trading taxable profit was 50,000. Sue is allocated an annual salary of 10,000 and Tim 15,000. The profit share until 31st August was 1:1. This was changed to 1:2 with no provision for salaries. Okay. Show the trade profit allocated for each partner for the period ended 31st December 2018. So what you need to do is, there are, in the 12-month period, The first 8 months, the profit share was 1-to-1, and the next 4 months, the profit share was 1-to-2. But the first 8 months, they received salaries of 10,000 and 15,000. So when we look at the example, the first thing that you need to do is to split the profit to the relevant accounting period. Okay, so for the first part, before any change in the profit sharing arrangement, the profit was 50,000 times 8 over 12 at a proportional basis of 33,333. Salaries of 10,000, 15,000, you need to apportion over 8 months, come to a total of 16,000. Then the balance is also 16,666, split 50-50. Okay, so for that first 8 months, sorry, you can see how the profit has been split together with the apportionment of the salaries. Yeah. For the following 4 months, it will be the balance of 50,000 minus 333, it gives you 16,667. And for that 4 months period, there's no salaries, yeah? So salaries is nil, so the balance will be split according to the new profit ratio of 1-to-2. So 667 divided by 3 times 1, and 16,667 times 2 over 3. So you have 5,556 and 1,111. Yeah, so the trade profit allocated to partners, the total will be to 20,556 and 29,444. Okay, so it's important that when there are changes to any condition during the year, you need to do an apportionment of the profit to what the pre-arrangement was and what the post-arrangement is. Okay, can understand? Okay. Yes, no, yes, no. Okay, silence means yes, no confusion. Okay, right. The next one is just an example on the change in membership of partnership. As I mentioned before, when there's changes in partnership, there could be admission of new partner, retirement of partner, removal of partner, or death. Okay, but usually in most of the examples given is just there's been changes, a new partner has been admitted or another partner has retired. Yeah. So in this case, what's this example? Daniel, Ashley, and Kate. So in this example, there's a partner joining the partnership. So I think first you had 2 partners, and then a partner was admitted during the year to become 3 partners. So again, what you need to do is to look at the chain of events. For how many months of the year were there 2 partners? What was the salaries and profit share? And when a new partner was admitted, when was he or she admitted? And what is the arrangement in terms of the profit share and the salaries, if any? Okay, so let's look at this. Daniel and Ashley have been in partnership for many years, preparing accounts to December, and they share profits in a ratio of 2-to-1. So in this example, I think there's no salaries. Yeah. On 1st June, Kate joined the partnership. From that date, profits were shared. Daniel 50, Ashley and Kate 25%. The partnership's profit for the year ended 31st December was 72,000. And for the year ended 31st December 2019, 90,000. Compute the partnership's taxable payable to Daniel, Ashley, and Kate for these 2 years. Forget about the overlapping profit for Kate. Yeah, I mean, for exams, usually I never ask you to do the overlapping profit. It's just for you to be able to do the allocation for each of the partners, and then for you to compute the profit. So when you turn to the next page, or the solution, again, it's the same principle. Yeah, for the first 5 months, there was only Daniel and Ashley. There's no salaries, only profit share. So the profit share was split 2-1, and then after 1st June, the profit was split 50, 25, 25. Okay, so then based on the profit allocation of 72,000, you split for first 5 months, and then you split for the next 7 months. And this is the profit allocation that you have for the 3 partners up to 31st December 2018. And then for 2019, because they've all been partners for the whole year, you don't need to do any apportionment. Just split the profit of 90,000 based on their profit sharing ratio or profit sharing arrangement. Okay, so the most important thing usually sometimes in a taxation question is getting the allocation right, calculating the profit proportionally properly, and then allocating the profit share, or if there are salaries, correctly to each of the partners based on the 2 different accounting periods, when there's been changes in partnership. I'm not sure whether there's an example about, okay, there's an example of leaving. I remember probably 5-6 years ago, one of the most popular questions in exam is putting 3 in one question. So here you have no changes in partnership, as an example. No change in partnership, but there's a change in the profit sharing ratio and salaries, another example. And then the other example is admission of partner, and another one is retirement of partner leaving the partnership. And one of the questions that always come out in an exam, but somehow it's not been done now, is an example of 4 partners eventually. So you start with 2, you admit 1, and then you admit another, and then another decides to retire, and you have to do the tax comps based on profits for 4 years. Yeah, so the answers come to about 2 pages because you need to do a split for every financial year. Yeah. So, but because the law had changed a little bit subsequently, and then to make it more complicated, in some years you have capital, some years you don't have capital. Yeah. So it is to test the students' approach, so that if you do the questions method in a proper method, where you do the apportionment, you do the split, you will be able to come up with the right answer. Yeah. So as you can see from the 3 examples, it's important that you know how to split the profit and also how to apportion the profit to the relevant partners. Now the next example is partners leaving the partnership, either through retirement, but most cases we're a bit polite in exam questions now. Partner has left because of retirement. So in this example, the next one is Maxwell, Laura, and Wesley. They have been trading partnership for many years. They prepared the accounts at the end of September. Each partner was entitled to 5% interest per annum on capital. So each partner had introduced 60,000 of capital on the commencement partnership. From that date, profits were shared in a ratio of 50, 30, 20. Okay, so you've already been given what the capital introduction is, 60,000 per person. The interest is 5%. And in order, then before you calculate the profit that needs to be distributed to each of the partners, you need to take into account the interest that will be paid to the partners. Yeah, and then the balance will be split depending on their profit ratio. So that's the first part of the partnership. And then on 1st of May, Wesley left the partnership. From that day, the profits were shared equally between the 2 remaining partners, and no interest was paid on capital. So it makes no difference whether interest is paid on capital or not, because the balance will still be split 50%, and the interest on capital is based on 5% of 60,000. Yeah. So whether you have interest on capital or not, you will still end up with the same figure at the end of the period. Yep. But if there was a difference in terms of the profit share, say 60-40, 70-30, then the partners will probably say that they will get interest on capital. Any balance will be distributed in accordance with the profit sharing ratio. So in this example, because it's split 50-50, it doesn't matter when you pay interest or not, the end profit allocated to the partners will be exactly the same. Okay. So the okay, and then the partnership taxable income for the year September was 120,000. And then we still had overlapping profit. Compute the partnership profits taxable on maximum. Then again, you do the same thing for the first 7 months. So it's October, November, December, January, February, March, April. Yep, 7 months. You calculate what the interest is paid to each of the partners, a portion 7 months, and then the balance of the profit is split by the profit sharing ratio, 50, 20, 30, and then the balance of 50,000 for the rest of the year, where there's only 2 partners, will be split 50-50. Yeah, then you'll come. Your total of profit allocated for the year of 120,000 will be 59,125 to Maxwell, 46,175 to Laura, and 14,700 to Wesley. Yeah. So as you can see from the examples, it's important for you to read the question properly, look at what the changes are during the year in terms of profit share and salaries for the first part. The second part, whether there's changes in the partnership. Has someone been admitted as a partner? Has someone been removed as a partner or retired as a partner? Yeah. Then you do the various calculations based on the changes during the year of whatever the facts that have been given to you. Yeah. Whether there's interest, whether there's salaries, and what the profit share is, or the changes in the profit share. Yeah. So far, so good. Partnership is quite a short chapter, actually. That's why I just started by giving a preamble on the earlier 2 lectures that I did. Yeah. So again, with taxation, you can see that there's a standard format. Yeah. So with partnership, you start with the total column on the left side, then the names of the individuals on top. Yeah, which is slightly different than the other way around. The reason why you start with total, because for partnership, the profit is always the balancing figure. Once you've taken salaries, once you've taken into account interest on capital, whatever balance there is of the profit net, all these expenses will be distributed or split based on the profit sharing ratio. So the most uniqueness about partnership account is you start with total first and then the names of the partners. Whereas if you go through the textbook, you'll see all the other examples where total is the last column. Yeah, there's a reason why total is done first here, because of the balancing figure that you need to calculate once you've taken into account interest on capital and salaries. Okay, any questions? Confused? It's okay. Just go through the example. Yeah. The question. If you're too shy, put in the chat group any questions before I sign off.
So far, okay, sir.
Okay, questions? Anybody? Are you listening, by the way?
Yes,
next time I ask you all to on your camera and on the mic so that I can hear reactions. Any questions? Yes. What's your question? Okay, so just go through the examples. Yeah, don't have to fully understand 100%, but at least understand the principles of how partnerships are allocated. So when you look, so just an example, yeah. So when you look at the profit that has been allocated to each of the partners, like in the last question, 59,000 to Maxwell, Laura 46, and to Wesley 14,700. This is the figure that you will slot in chapter 1 under non-savings income. So when you're calculating the tax liability, so this is the profit allocated, then you need to calculate the taxable income. Yeah, in the example, you have your profit allocated less personal allowance. But there might be cases where some of these partners may have investment savings income, and they may have investment and hence dividend income. Okay, so when you look at the first chapter where you have savings, non-savings, and dividend, the profit allocated to each of the partners will be their non-savings income. And then if they have savings income, dividends, you add it all together, then depending on what their taxable income is, this will dictate what the tax rate that you use in the tax tables. Okay, so yes, you have your partnership where you have your total profits, but once you allocate the profits to the individuals, then the individuals will be subjected to personal income tax individually in the partnership. Okay, and then the next part is losses. The losses are also similar. You allocate the losses based on the profit share, which can be carried forward for future years. Okay, so what's my next? The next thing that I'm going to do next week is chapter 13. Okay, so I'll skip national insurance and all the others. What I might do, I'll try and see, because in terms of the syllabus, I only have 1, 2, 3. Actually, I have 6 chapters to go. But what I may do is for chapter 13, computing chargeable gains, I might also do it together with chargeable gains for companies, yeah, so that you can see the difference. I'll just do 2 in 1 because the principles are the same. And then business relief can be on shares and securities. I can do it together with companies. Then the last chapter will be losses, so I might mix it with actually on corporation tax I can do it in 1 lecture, because computing gains, computing taxable income is similar to chapter 7. Chargeable gains for companies maybe I'll cover together next week, and then losses, that's it. So maybe three more lectures will be finished. Okay, and then what I'll do for your next assignment, I think I'll make it easier. I'll just give a short assignment. Just work in a group and just probably about 2,000 words. I won't make it 2,500, 3,000 words. Make it short so that because you'll probably only have 1 month or 5 weeks to prepare. I will give it to you by this Sunday because I'm still deciding how to do it. I just found that a lot of lectures haven't given the information that's requested by the faculty in terms of accreditation for ACCA. And then I saw some of the information submitted. There was a lot of queries, so I want to make sure that we don't have that many queries. But I cannot give you a computational question because once I give you a computational question, everybody will get 100% anyway. Yeah, because it's going to be quite easy anyway. So it'll be another essay type. But I'll try and get it done and give it to you by the end of this week. If you don't get anything by Sunday, please remind me. Tell me in the WhatsApp group. Hey, where is the second assignment? Yeah, just to remind me. Okay. Because I think in between now and then I also have a lot of conferences that I've been attending or speaking in. Okay. So that's, oh, I remember I forgot to on my camera, but you don't need to see me anyway. Yeah, you just have the PowerPoint. So if there's nothing, I'll let you have your lunch. Then I'll speak to you next week, 12:30, same time. Yeah. If it's going to be a longer lecture because I'm going to put 2, then I'll start a bit earlier, but I will message you if I start earlier. Okay? If there's nothing, I mean, speak to you next week. And again, stay safe, take care. I get worried that cases still, 305 2 days ago, 190 plus yesterday, 3 deaths. I pray that today we'll see a further reduction. I'm planning to fly back to Brunei on the 14th of November. So hopefully by the time I come back, things will get better and start improving. But to be honest, if there's still more than 100 cases till Sunday, I think the government has no choice but to do a full lockdown. And as usual, there are a lot of stubborn people still not adhering to the law. At least the government is making lots of money with all these fines and penalties that they're paying. But it's not good for the safety of people like you, me, the general public, when people are being irresponsible. Yep. So stay home, stay safe, take care of your health and your mental health as well, which is very important, because you need all of this to see you through this semester and next semester. And hopefully I can see you all physically next semester, even though I cannot do lectures, but if you can do what we do last year, smaller groups for tutorial, that will be good, because auditing is going to be difficult for me to do online because it's quite a difficult subject. And I can tell you that after 10 minutes, you probably switch off and do something else and come back when I finish my lecture, and sign off. Yeah. Okay. So if there's nothing, I'll see you all, speak to you all next week. So, take care and stay safe. Okay. Bye.
Bye.
Thank you, sir.
Thank you, sir.
Okay. See you guys.
Thank you, sir.
Welcome all.